Question number 3. On 1st of April, PQR acquired 30% of the voting rights for 8,000 and accounts its investment using equity method. So now we understood it is a CFS they are talking about. As on 31st March, they recognized its share of profit using equity accounting. So they said their share of profit is 700, OCI for exchange difference as per India's 2100 and revaluation reserve as per India's 16 is 50. Now the book value of the investment in associate at the end of the year, 31st March 2012, was 8850. How did you get 8,000 plus you recognized your share of profits and OCI, which they have already given you also, which in exam they may not give you. Now on 1st April, PQR acquired remaining 75% of the cash. So now it is no more associate, it is a subsidiary for you. So from 28, you have to shift to 103 for 25,000. So fair value of the business, fair value of 30% interest already owned they have given you. If this information was not there, what you would have done? 25,000 divided by 0.7 into 30% you could have done. And identified net assets. See, this is different from the value of the business. Value of the business is market price into number of shares, FCFF, earnings capitalization. You can have a different dividend capitalization. So many methods you will have. But this is net assets. Individual assets have been revalued. Now, how you should account for this business combination? See, first of all, when you talk about accounting of the business combination, see, the question is very silent here. What exactly, how to account? Are they asking journal entries? Is it a calculation? Yeah, some calculations are involved. But primarily, if I look at the solution, they are asking journal entries. So in the examination, they may ask you journal entry. Alternatively, they may not ask you. They may ask you as it is. But we know, okay, we need to pass the journal entry. But simply I cannot pass the journal entries. Because if they tell me pass the journal entries, I will straight away pass the journal entries. But when they give me the word called account, I may have to explain it. And the word step acquisition has to come in my answer. Followed, no? Yes. So before we proceed, I just wanted to remind you, we discussed it lot many times. See, the item not subject to recycling is revaluation surplus, and item subject to recycling is the exchange difference, which we discussed on our day 1 schedule 3 format. So on 1st April you acquired the investment, you took the investment and you took your share of profits. Now your balance sheet is looking like this, and you sell the investment. That means you do, okay, if assume you sell the investment